This is Learning Objective 1 in Module 1. And our approach to financial statement analysis is going to be premised on a very basic idea about how companies operate. And that idea is that you can break up a company's management and decision making into four basic kinds of activities. And that is planning, financing, investing, and operating. So, for example, the way you would think about this is if you were to start a business, the first thing that you would do is you would have a business plan. And that business plan, you would write out everything that you intend to do with your business. Then you would finance it. In other words, you would find where to get the money in order to pay for all the wonderful things that you would want to do. Then you would take the money that you get from the financing and you would invest it in assets and other things that you need in order to do your plan. And then operations, you're going to run your business itself. So planning, financing, investing, and operating are the four basic kinds of activities that a company can do when it manages itself and when it makes decisions. And you don't have to just look at this in terms of a startup. You can look at it in terms of how you operate, because every business needs to go through a budgeting process where they're going to plan what happens over the coming year and the coming future years. Then they need to make sure that they're going to have the money in place in order to fund all their wonderful plans in their budget. They may need to borrow money. They may need to issue stock regularly. Then they're going to invest the money, continuously invest the money in assets that they need in order to do their operations. And they actually need to operate. So this can be looked at in terms of starting a company, but more importantly, it should be looked at in terms of how companies run. Now, we can look at these in terms of financial statements themselves, because a company has these operating, investing, and financing activities, and we usually think about these as accountants in terms of the cash flow statement. But reality is that operating, investing, and financing activities, in addition to planning, is how business works. And so a company needs to plan what these operating, investing, and financing activities are going to look like. And these, you're going to have your financial statements and then all sorts of activities, and then new financial statements that come out at the end of the year. And the process of financial statements, preparing financial statements, and operating is all really intertwined, because financial statements are just an accountability tool for what happened during the year. Now, what we're going to do in this course is we're going to look at companies and financial statement analysis in 4 steps. And this is really the key to how we're going to do things. And the first step is to just understand the environment that a company is operating in, and also understanding the accounting information that we have. So, in essence, you would look at a company, look at its business, look at the environment that the business is operating in. And that's the first thing, is just try and understand what's going on, so to speak. The next step is adjusting and assessing. In essence, looking at your financial statements and analyzing those financial statements with various qualities. And this would mean looking at profitability, looking at the amount of debt and leverage, understanding companies' operations, investing activities, financing activities, and their plans. That would be step 2, to really understand, to take the information that you have from step 1 and understand more about the company by doing some basic analysis. Step 3 would be to forecast into the future what you think is going to happen. So that often involves creating financial statements that reflect your expectations for the coming years. And then step 4 is to use those forecasts to value the stock. So there are different methods for doing this, and we'll go over several different methods for doing it. And the end product of this 4-step process is to come up with your estimate of what the company is really worth. And if the stock price is less then that means it's a good deal. If the stock price is more, that means it's a bad deal. In other words, if you go through this whole analysis and you determine that the stock should be about $20 a share, and right now the stock is trading at $15 a share, that would mean that this stock is a good deal. If on the other hand you determine that the stock is worth about $20, but right now it's trading on the market at $40, that would tell you that the stock is overpriced and this is probably not a good investment. So you would go through these 4 steps, and we're going to go through them throughout the course to better understand whether or not a company is a good investment.